Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a story that's been making waves in the tech industry, the massive AI spending plans of giants like Meta and Microsoft. These companies have been pouring billions of dollars into artificial intelligence, but investors are growing increasingly skeptical about these investments. Meta, for example, has announced plans to spend up to $72 billion on AI capex in 2025, with even more spending expected in 2026. Meanwhile, Microsoft reported a record $34.9 billion in capex in the last quarter, with spending expected to increase further in 2026. But despite these massive investments, investors are starting to punish these companies for their colossal AI spending plans. Meta's stock price dropped as much as 14% after its earnings report, while Microsoft's shares fell by 3% at intraday lows. Some analysts are warning that the AI trade is starting to show signs of a bubble, with monetization plans remaining unclear despite the massive amounts of cash being poured into chips and data centers. In fact, Amazon, Meta, Microsoft, and Google could spend as much as $320 billion on capex related to AI infrastructure this year alone. While it's true that AI has the potential to revolutionize many industries, investors are right to be cautious about these massive spending plans. After all, we've seen similar market fads come and go in the past, with companies like Meta pouring billions into concepts like the metaverse, only to report significant losses later on. As Peter Berezin, chief market strategist at BCA Research, put it, when a large tech company announces plans to spend more on capex, but its stock price drops as a result, that's a yellow flag for the AI trade. We'll be keeping a close eye on this story and bringing you updates as more developments unfold. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're continuing our discussion on the latest developments in the business world. Today, we're focusing on the financial performance of several key players in the industry. First off, let's take a look at Phoenix Mills Ltd., which has reported a 39% increase in its consolidated net profit to Rs 33.99 crore during the second quarter of this fiscal year. This significant jump can be attributed to higher income, with total income rising to Rs 1,114.21 crore from Rs 955.06 crore in the corresponding period last year. The company's developments in retail-led mixed-use projects have been a major contributor to its growth. On the other hand, Mahindra Lifespace Developers Ltd. has also made a notable turnaround, reporting a consolidated net profit of Rs 47.91 crore for the second quarter, as compared to a net loss of Rs 14.91 crore in the year-ago period. The company's total income rose to Rs 33.06 crore during July-September this year from Rs 115.96 crore last year. In other news, we're seeing significant movements in the real estate sector, with companies like Mahindra Lifespace Developers Ltd. and Phoenix Mills Ltd. making strides in their respective domains. It's essential for investors to stay informed about these developments and make informed decisions based on their financial goals and risk tolerance. As we navigate through the complexities of the business world, it's crucial to maintain a balanced perspective and consider multiple factors before making any investment decisions. We'll continue to bring you updates on the latest market trends and analysis to help you make more informed choices. Welcome back to the Riskwiser Zone. Today, we've been exploring the world of finance and technology, and now it's time to dive into our closing segment. We have 3 interesting stories to share with you, all related to recent earnings reports from major companies. First up, let's talk about Western Digital, which just reported its fiscal Q1 2026 earnings. The company beat estimates once again, with revenue coming in at $2.82 billion and adjusted EPS hitting 1.78. This is a significant jump from last year, and CEO Irving Tan credited the strong demand for data storage in the cloud, driven in part by the growth of AI. Western Digital also raised its dividend by 25%, which is great news for investors. Next, we have Atlassian, which reported its own earnings recently. The company authorized a 2.5 billion share repurchase program and was named a leader in the 2025 Gartner Magic Quadrant for DevOps platforms. CEO Mike Cannon-Brookes emphasized the pace of AI innovation and enterprise adoption, positioning Atlassian as an infrastructure play for enterprise AI workflows. The company's cloud revenue is expected to grow roughly 22.5% in Q2 FY26, with non-GAAP operating margin holding at 24.5%. Last but not least, we have a story about Western Digital's rival, although not directly related to its earnings report. Instead, it's about the broader tech industry and how companies are performing. X, formerly known as Twitter, is not the focus of our discussion today. Instead, we're looking at how other companies like Atlassian and Western Digital are navigating the current market landscape. As we wrap up today's show, it's essential to remember that the market is constantly evolving, and companies must adapt to changing trends and technologies. While some companies are thriving, others may be struggling to keep up. As investors, it's crucial to stay informed and make informed decisions based on your individual financial goals and risk tolerance. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.